Now, the news coming in today is that NTPC's tax-free bonds will open today. This is the first tax-free bond issue of the year where retail subscribers can also subscribe. There is a limit of, I think, 10 lakh rupees for retail investors, and 40% will be kept for the retail investors. So is this a good investment option for investors? To talk to us about this, we are joined by Harshroongta, investment advisor and founder. He has his website, harshroongta.com. He is joining us now from Mumbai. Thanks so much for speaking with us, Mr. Roongta. What would you say? Is this a good investment option? Because, for people who do watch out for these tax-free bonds, last time NTPC came out with a bond like this, tax-free bond, the interest rates were closer to 8.9%. And this time they range between 7.5% to about 10.6%. So just the, apples to apple comparison makes you feel the interest rates is lower. What would you say?
So interest rates on tax-free bonds are decided based on the equivalent interest rate of the government securities in the last quarter, and a small markup on that is allowed. That's the formula that's already been laid down. So at a time when the government securities interest rate has dropped a bit, obviously the bond rates would have to drop. Because that is the formula. The old bonds which were issued at a higher rate will today be quoted at a premium because the overall rate expectations have come down since that time. As far as this particular issue is concerned, clearly it is coming out at a time when interest rates are expected to go down reasonably significantly over the next quarter itself, if not definitely over the year. And therefore, I think, as you mentioned, if you have an opportunity, if you have the requirement to invest in debt, and you are on a very high tax bracket, which means your taxable income is higher than 10 lakhs, then I think this is a good opportunity for at least people with some fair amount of money in their portfolio for this particular opportunity. It is also a reasonably good short-term opportunity because, as I said, the market expects the interest rates to drop. If they actually drop, there will be a premium on these bonds, and there is a decent amount of liquidity, so you will be able to get out at a premium. So I think, to summarize, as a short-term opportunity, it is definitely worth a try for the retail investors, and even as a long-term opportunity, to the extent that you have space for debt, you are high net worth, and are in the high marginal tax bracket, which means you have taxable income more than 10 lakhs, this would make sense.
Right. Mr. Roongta, you said that, even in the short term, it's a good opportunity because interest rates are expected to go lower. Can retail investors actually trade in these bonds? Is it easy to do this?
Let me say that, it is not that difficult. Whatever, those people who have trading accounts, they will be able to trade. And trades do happen. And I think in the scenario where interest rates are dropping, you will have a fair amount of liquidity, especially when the issue is new. Because at that time, there is a fair amount of liquidity. After, say, 2 months or 3 months, the liquidity may dry out and may not be as good. But during the first 2-3 months, there will be a pretty decent amount of liquidity.
Right. How do they compare with the bank FDs? Because bank FDs, some at the higher end, are still offering 8% plus as an interest, payment. It seems a little less, but post-tax, how does it compare?
So if you are, as I said, you can only compare post-tax, and typically if you are in the higher tax brackets, then above 10 lakhs, you have pay a 30% tax. So your 8% effectively is a return of about 5.6% rather than 8%, which you can compare with the 7.5 that you are going to get here. The Other thing is the ability to earn a premium in the current environment, which you only have on a tax-free bond. You don't really have it on a bank FD. So I think for people in high tax rates and who require debt, I think tax-free bond is a good option.
Right. And, we have options like PPF, where you can invest up to, I think, 1.5 lakhs. Should an investment be made there before you invest your cash into debt or the bonds that NTPC has come out with? Because there the interest rate is higher.
So I think PPF is not really a comparable option because of two reasons. There is very little, there is no liquidity in the PPF. Your money is locked in. Plus there is a cap. So to the extent you don't mind a lock-in, obviously PPF is your first choice. But then that money is capped at 1.5 lakhs. Whereas a tax-free bond is an ongoing opportunity. Today it is NTPC. If interest rates go down, then future tax-free bonds would come out at a lower rate. And these tax-free bonds would be quoting at a higher rate. So I don't think this is very comparable with PPF. But if you are okay with a lock-in, then what you said is correct. You first do PPF, and then that's only 1.5 per account, 1.5 lakhs per account. Balance you would have to do on instruments like the tax-free bond.
Right. Mr. Roongta, since you are joining us, I just wanted to ask you another question, because a lot of people will be thinking about, parking their money. Now the government is also going to come out with the gold bond, the sovereign bonds, and of course there's the deposit scheme as well. How would you rate the sovereign bond scheme for all the details that we have now compared to, say, a gold ETF?
The way it looks, because we don't have some very, very crucial details, more importantly, the interest rates that will be paid on the sovereign gold bond scheme. Basically, even if the interest rates, the market is talking about a 3%, 2.5% to 3% interest rate on the sovereign gold bond scheme. Even if it is a little lower, definitely that would make more sense than the gold ETF. Just a word of caution. There is a 500 gram limit on the sovereign gold bond scheme per person. There is no limit in the gold ETF. But I think for a retail investor, 500 grams is roughly 14 lakhs. So I think per year, that's a per year limit. So I think for retail consumers, 14 lakhs is pretty good. But again, it is relevant to the extent of the allocation you have for gold. It is not really comparable across asset class. But within gold, I personally feel, depending on the terms, I personally feel that ETFs will have a difficulty surviving if the sovereign gold bond scheme, as and when the sovereign gold bond scheme comes out.
All right, Mr. Roongta, again, a last question before I let you go.
Sure.
And the markets, the equity markets have corrected, and there's so many options coming in front of people who may want to invest their money, be it the sovereign gold bond scheme that's due to come, tax-free bonds. NTPCs come out, and you say these are not ones to miss out on, because here on interest rates are going to go lower. Plus, equity markets have corrected so much. So if, say, I have ₹1 lakh and I want to invest, how should I break it up between the different categories at this point of time, seeing what lies ahead?
So my answer to that is, there is no real one answer to that, because I don't think the answer for one person will be the same as the answer for another. It depends on when do you need the money, what is your ability to take risks, what do you need it for. If you need that money after 5 years or 10 years, the answer would be very different, and it will be more tilted towards equity. More longer term it is, more aggressive your risk profile, it will be tilted towards equity. Lower your period, lower your risk profile, it will be tilted towards debt. And gold, I think, will fall in between with a certain cap. I think gold between 5 to 15%, depending of your total portfolio, should be gold. But again, as I said, it will be different for different people.
All right, Mr. Roongta, thank you so much for speaking with us at NDTV Profit, giving us your views on the NTPC tax-free bond issue that is open today. Mr. Roongta feels that it is a good option for those who are in the high income category. There is a limit of 10 lakhs per investor that you can put into these tax-free bonds, but the expectation is that interest rates are headed lower, so these bonds will trade at a premium, and Mr. Roongta feels it is a good bet. We'll slip it to a break this point in time. There's more market action and updates coming for you on the other side. Stay with us.